Hi everyone, this is May. My name is May Dildalau, and I am talking to you today on YouTube. Creative Abundance Now is my channel. I'm talking to you on Instagram live. May Dildalau is the channel, and the blog. I am live on the blog right now, and that is yesfinanciallyfree.com. Thanks for being on the live. I so appreciate you all, and I want to tell you a little bit myself, but first I want to tell you what I'll be talking about. We will be reading Chapter 7 of The Intelligent Investor by Benjamin Graham. Portfolio policy for the enterprising investor, the positive side. Okay, so that's what we're talking about today. And this book is recommended by Warren Buffett as one of the greatest books ever written on investing. And Benjamin Graham is Warren Buffett's teacher. So I think we should learn from the person who taught Warren Buffett, don't you? And the book is older, okay? This book was written in 1971 or 72, all right? So it talks about the state of the economy at that time, which is really interesting because the author also knows about the Great Depression. So he talks a lot about the Great Depression. And fascinating to me that right now, Ray Dalio says we are in the beginning of the second Great Depression. It'll take 3 years to recover from this economic crisis, and we're going to have depression-like things happen. So to me, it's very timely to be reading this book because he has very good perspective on the Great Depression because he actually lived through it. And he talks a lot about what had happened since then in the 30 years since the Great Depression. I think it's a good book to read. So, and a lot of what he says is relevant today. It's the same. It's the same as today. Some of it may not be relevant because he refers to tax law, which I don't know if it's relevant. I'd have to look it up. But most of it is the same. So we're learning good stuff, guys. Now, just so you understand, as I said, my name is May Dildalau. On this blog, I want you to go there. Put in your first name and your email address on the right side. Yesfinanciallyfree.com if you have not done so already. Get the free ebook, Working Parents Guide to Financial Freedom, emailed directly to you instantly. And get on my email list so you get emails telling you when I will be live and what I will be talking about. So for the past week, I've been doing a live every day, doing one chapter of this book. So today we're on chapter 7, right? So I've been doing one chapter a day every weekday. And every weekday I send an email to my email list and tell them what chapter are we talking about, what the topic is, how to click on to get on live, and if they want to see the replay, where to go. And I do this every week that I have a live or I have a training or I have a new blog post. So it's a great way to see what great content I have, decide if you want to click on the links and go to the blog and find out more or watch the live or get on with me. So this is a great website, yesfinanciallyfree.com. So go there, put your first name and email address on the right side. And on the top, there's a products portion where you can look at all the services I have, which range from $7 to $5,000, okay? And like I said, my name is May Dildalau. I live in Honolulu, Hawaii. Thank you for being on, guys, by the way. Let me know where you are from. And share this with your friends and followers. If you haven't subscribed to the YouTube channel, do it now. Instagram. Share this with people. It's good knowledge. I live in Honolulu, Hawaii. I used to be terrible with money. Okay, in 2011, I owed over $40,000 on like 8 different credit cards, lines of credit. I didn't own any property, didn't really have assets, except maybe a little bit in a 401k. But I was in debt, all right? And I was a banking assistant, all right? I didn't have a big job. I wasn't a fancy, prestigious. I was an assistant to a banker. So I made about $34,000 a year before taxes were taken out, guys, okay? So that was me. And so I owed way more than I made in a year. I was having a hard time with money, okay? I was living paycheck to paycheck. Sometimes my checks didn't cover my rent. They would bounce and I'd have to pay fees and I'd have my car would get towed. All those things that happen when you're not good with your money happened to me, all right? And I would cry. I would cry a lot about my money situation. I'm not going to lie. Now, 2016, paid back all the debt, improved our family's net worth by $500,000. We were making passive income of about $500 a month And I quit my job as a banking assistant, became a full-time mother, and a part-time Finance Freedom Mastermind coach. So I have a son right now. He's 6 years old. When I quit my job, he was 3 years old. So I've been doing this for 3 years now. Isn't that exciting? Now the blog, yesfinanciallyfree.com, I started when I was still working, but Finance Freedom Coaching, I started doing that when I quit my job. So what is Finance Freedom Coaching? You can check it out. Like I said, yesfinanciallyfree.com. Go to the products tab. You can see all that I do. But basically, I help people pay down their debt and make passive income at the same time so that they can become financially free as quickly as possible, increase their financial intelligence so that you have more free time to do what you love. Okay? In 2017, we bought our first property together. In 2018, we bought our second property together. It was an investment property and Airbnb business, which we still have today. 2019, we sold our first property and bought this property. But before we sold it, we turned it into a profitable Airbnb business and sold it to our manager, who was also our client, one of our Finance Freedom Mastermind clients. So we work hard to help you become free faster. And this condo is in Waikiki. It's beautiful. It's wonderful. We can walk to the beach, and we have been doing that almost every day. Walk to the beach, swim in the ocean. During this COVID pandemic, we are allowed to go swim in the ocean. We're not allowed to hang out on the beach or anything, but we're allowed to go into the ocean. So we boogie board, we surf, we have fun, body surfing, swimming. Yesterday we were swimming in the ocean. It is gorgeous here, and I am blessed, all right? And I want to help you become blessed too, okay? If I can do it, you can do it. I went on 5 weeks of vacation in 2017, went on a cruise to Mexico, never been on a cruise before. It was one of my dreams, you know. I went to Toronto, visited family, went to Niagara Falls, went to Washington, D.C., saw the cherry blossoms, went to L.A. So why am I telling you all this stuff? Is to tell you it's possible. You can be in big debt right now, not have a prestigious job, make a living, but be paycheck to paycheck, not know what you're doing, and you can turn your life around, and you can have free time. You can do what you love, all right? Just like me. I am a mother, stay-at-home mom. I love it. It is what I love to do. Now, everyone's different, okay? You might not love that. I love being a part of my son's life. I love being a mother. I love taking care of him. I love teaching him. He's being homeschooled right now, and I was already okay with that. Not exactly okay with it, but I'm okay with it now. I'm already at home. I love my son. See, and I love my husband. We go on date nights every week, right? We skipped a week during the beginning of the whole COVID shutdown, but we're going on date nights every week now again. We've been doing it for years because I love my husband. I love my family. So I want you to do more of what you love, all right? So that's what Finance Freedom Mastermind is about. You might think it may be only about money, but it's not. It's about time. It's about choices. It's about living your dream life. It's about being practical. It's about if you're a full-time mother or father and you're working and you're busy, it's about changing your life so that you are no longer so busy. Do you understand? You can go work out. You can become healthy. You can even have a cool goal, like do an Ironman like I did in 2011 or whatever, you know. You can go for it. You can become healthy. You can be connected with your family, have a great loving relationship with your spouse. You can do all that. That's what Finance Freedom Mastermind is about, and that's what yesfinanciallyfree.com is about. I believe in constant education and learning, all right? So if you surround yourself with people like me, you will be lifted up. That is just a fact. And that is why I'm reading a book to you today. I have never read this book before. So as I'm reading it, it's the first time for me too. This is a way to motivate me to read this book, which I know is good for me. If we are actually, as Ray Dalio says, in the beginning of a huge depression, I want to know how to invest the most wisely to make the most for my money, get those 300% returns at the end of these 3 years. So how do you do that? Well, you learn from smart people. So learn with me, all right? And if you don't want to hear the whole book, or if the English is too hard for you because it is old English, you are welcome to go to my blog. I put the blog post underneath this YouTube video. If you're on the blog, you're on there already. And Instagram, the link is in my profile. Go there you will go directly to my blog. And as I'm reading this every day, I'm putting a little bit of a summary under it. So if you don't want to watch the whole video or listen to the whole book, you can go in there and you can read a summary of the book. Once I'm done reading it, it'll all be in there. Okay, so just so you guys know. Okay, let's begin. Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side. The enterprising investor, by definition, will devote a fair amount of his attention and efforts toward obtaining a better than run-of-the-mill investment return. In our discussion of general investment policy, we have made some suggestions regarding bond investments that are addressed chiefly to the enterprising investor. He might be interested in special opportunities of the following kinds. Number 1, tax-free new housing authority bonds effectively guaranteed by the U.S. government. Taxable but high-yielding new community bonds also guaranteed by the U.S. government. Tax-free industrial bonds issued by municipalities but serviced by lease payments made by strong corporations. References have been made to these unusual types of bond issues in Chapter 7. At the other end of the spectrum, there may be low-quality bonds obtainable at such low prices as to constitute true bargain opportunities, but these would belong in the special situation area where no true distinction exists between bonds and common stocks. Operations in common stocks. The activity specially characteristic of the The activity specially characteristic of the enterprising investor in the common stock field may be classified under 4 heads. Number 1, buying in low markets and selling in high markets. Number 2, buying carefully chosen growth stocks. Number 3, buying bargain issues of various types. And number 4, buying in special situations. General market policy formula timing. We reserve for the next chapter our discussion of the possibilities and limitations of a policy of entering a market when it is depressed and selling out in the advanced stages of a boom. For many years in the past, this bright idea appeared both simple and feasible, at least from first inspection of a market chart covering its periodic fluctuations. We have already admitted ruefully that the market's actions in the past 20 years has not lent itself to operations of this sort on any mathematical basis. In other words, people are not buying low and selling high. It just doesn't happen that way. The fluctuations that have taken place, while not inconsiderable in extent, would have required a special talent or feel for trading to take advantage of them. This is something quite different from the intelligence which we are assuming in our readers, and we must exclude operations based on such skill from our terms of reference. The 50-50 plan, which we propose to the defensive investor and described on page 42, is about the best specific or automatic formula we can recommend to all investors under the conditions of 1972, which means 50% means put 50% of your money in stocks and 50% of your money in bonds. Okay, we have retained a broad leeway between the 25% minimum and the 75% maximum in common stocks, which we allow to those investors who have strong convictions about either the danger or the attractiveness of the general market level. Some 20 years ago, it was possible to discuss in great detail a number of clear-cut formulas for varying the percentage held in common stocks, with confidence that these plans had practical utility. The time seemed to have passed such approaches by, and there would be little point in trying to determine new levels for buying and selling out of the market pattern since 1949. That is too short a period to furnish any reliable guide to the future. Growth stock approach. Every investor would like to select the stocks of companies that will do better than the average over a period of years. A growth stock may be defined as one that has done this in the past and is expected to do so in the future. Thus, it seems only logical that the intelligent investor should concentrate upon the selection of growth stocks. Actually, the matter is more complicated, as we shall try to show. It is a mere statistical chore to identify companies that have outperformed the averages in the past. The investor can obtain a list of 50 or 100 such enterprises from his broker. Why then should he not merely pick out the 15 or 20 most likely looking issues of this group, and lo, he has a guaranteed stock portfolio? There are two catches to this simple idea. The first is that common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in his judgment of their prospects and still not fare particularly well, merely because he has paid in full and perhaps overpaid for the expected prosperity. The second is that his judgment as to the future may prove wrong. Unusually rapid growth cannot keep up forever. When a company has already registered a brilliant expansion, its very increase in size makes a repetition of its achievement more difficult. At some point, the growth curve flattens out, and in many cases, it turns downwards. It is obvious that if one confines himself to a few chosen instances based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? He has a footnote here, number 2. And the footnote is a growth stock may be defined as one that is on the sentence that a growth stock may be defined as one that has done this in the past and is expected to do so in the future. And then he writes, number 2, a company with an ordinary record cannot, without confusing the term, be called a growth company or growth stock merely because its proponents expects it to do better than the average in the future. It is just a promising company. Okay. So he's saying that a growth stock has to have proven growth over a certain period of time. Okay. It is obvious that if one confines himself to a few chosen instances based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? We think that reasonably sound conclusions can be drawn from a study of the results achieved by the investment funds specializing in the growth stock approach. The authoritative manual entitled Investment Companies, published annually by Arthur Wiesenberger and Company, members of the New York Stock Exchange, computes the annual performance of some 120 such growth funds over a period of years. Of these, 45 have records covering 10 or more years. The average overall growth for these companies, unweighted for size of fund, works out at 108% for the decade, 1961 to 1970, compared with 105% for the S&P Composite and 83% for the Dow Jones Industrial Average. There's a see Table 7.1 is this footnote. So there's Table 7.1 here. If you want to snapshot it on your screen, save that on YouTube. And then here it is on Instagram. If you want to save that. Okay. And we'll look at Table 1 real quick. It just shows 1 year, 5 year, 10-year performances and their dividend in 1970. 17 large growth funds. In 1 year, they had negative 7.5% growth, but in 10 years, they had 121% growth, which is the highest. 106 smaller growth funds, Group A, negative 17% in the first year and plus 102% in the 10th year. And they're actually ranked according to dividend returns. So the 17 large growth funds had a 2.3% dividend return, and the 106 smaller growth funds in Group A had a 1.6% dividend return. 38 smaller growth funds had a negative 4.7% return in the first year, 106.7% return in 10 years, and they had a dividend return of 1.4. 15 funds with growth in their name, that's hilarious, negative 14.2 return in the first year and negative 97.4% return in 10 years. 1.7 was their dividend. The S&P was up 3.5% in 1 year and 104% in 104.7% in 10 years, with dividend return of 3.4. And the Dow Jones Industrial Average was up 8.7% 1 year in 1970 and up 83% over 10 years from 1961 to 1970 with a dividend return of 3.7. Okay, so they're not ranked according to dividend. I don't know what they're ranked by, but anyway, it's all good. So that's the table. So let's take a look. Okay. The average overall gain for these companies unweighted for size. Where are we going here? Blah, blah, blah. Okay, where's my footnote? Where is that footnote? There. All right. In 2 years, 1969 and 1970, the majority of the 126 growth funds did worse than either index. Similar results were found in our earlier studies. The implication here is that no outstanding rewards came from diversified investment in growth companies as compared with that in common stocks in general, the whole index. There is no reason at all for thinking that the average intelligent investor, even with much devoted effort, can derive better results over the years from the purchase of growth stocks than the investment companies specializing in this area. Surely these organizations have more brains and better research facilities at their disposal than you do. Surely, right? Surely. Consequently, we should advise against the usual type of growth stock commitment for the enterprising investor. This is one in which excellent prospects are fully recognized in the market and already reflected in a current price earnings ratio of, say, higher than 20. For the defensive investor, we suggested an upper limit of purchase price at 25 times average earnings of the past 7 years. Two criteria would be about equivalent in most cases. Striking things about growth stocks as a class is their tendency toward wide swings in market price, such as General Electric and International Business Machines, IBM, and even more so of newer and smaller successful companies. They illustrate our thesis that the main characteristic of the stock market since 1949 has been the injection of a highly speculative element into the shares of companies which have scored the most brilliant successes, and which themselves would be entitled to a high investment rating. Their credit standing is of the best, and they pay the lowest interest rates on their borrowings. The investment caliber of such a company may not change over a long span of years, but the risk characteristic of its stock, of its stock will depend on what happens to it in the stock market. The more enthusiastic the public grows about it, and the faster its advance as compared with the actual growth in its earnings, the riskier a proposition it becomes. Where are you from, Kizar? Thanks for joining the live today. Okay, but it is not true, the reader may ask, that the really big fortunes from common stocks have been garnered by those who made a substantial commitment in the early years of a company in whose future they had great confidence, and who held their original shares unwaveringly while they increased 100-fold or more in value? The answer is yes, but the big fortunes from single company investments are almost always realized by persons who have a close relationship with the particular company through employment, family connection, etc., which justifies them in placing a large part of their researches in one medium and holding on to this commitment through all vicissitudes despite numerous temptations to sell at apparently high prices along the way. An investor without such close personal contact will constantly be faced with a question whether too large a portion of his funds are in one medium. Each decline, however temporary it proves in the sequel, will accentuate his problem, and external forces are likely to force him to take what seems to be a goodly profit, but one far less than the ultimate bonanza. Pakistan. Well, welcome, Kizar, to the live. I appreciate you being here. Thanks for joining. I am in Hawaii right now. I live here. Okay, so that is so true. What he just said is so true, by the way. When people start a business and you say the initial investors made out and all that, there are a lot of businesses that don't go well. Okay. And it's true. Family and friends are the ones who initially invest, and they will stick to it because of family, I have an Airbnb business with my husband. And obviously, if you know anything about Airbnb in Hawaii, the tourist industry has basically been shut down here because of COVID-19. Yeah. So we had cancellations upon cancellations in March, and they got full refunds because it's an epidemic. And so we were making no money in March. We were so lucky to have a booking and to make our mortgage and payments. And I was thinking, should we just sell this? This Airbnb business, the reason that we have it, one of the largest reasons we have it, is because it employs my mother, who does not have steady work. But with this business, she has steady work. She helps visitors to Hawaii get acclimated here. She cleans the unit. We pay her to do these things. So if we give up this business, we're giving up her job, which is my mother. All right. So yes, family and friends will give you more incentive to keep a business when times are rough. I am a real example of that. So I've thought about it. Should I put this up for sale? Should we just because we could get a really good price right now. The housing market hasn't dropped yet, if it's going to, and we could get a good price. But, I was like, well, it's in God's hands. I was like, God, show me. And amazingly enough, we are getting bookings. Even when the law changed recently, and we are not allowed to rent for less than 30 days in April because we have this stay-at-home order in April. And the law just got passed in the 9th of April. And I just saw it like 2 days ago because who knows when these things, I didn't know about it. And so we had one person book 3 weeks and we changed the reservation to a month so we could fall within the law. And we did that. We had exactly 30 days left to modify it. Otherwise, we'd have to cancel the whole reservation. So God apparently is sending us enough income to keep the business afloat during this crazy time in our economy. And so as long as that happens, I'm going to keep the business because it is my mother's main employment source of income. So yes, you might say that, oh, they're so smart to keep this company and they started it, but they put sweat, tears, they put a lot of effort into it. And they deserve it. That's all I have to say. I mean, look at Elon Musk. Look how hard he works. He's probably one of the hardest workers ever, right? Or Bill Gates, Warren Buffett. Everybody who knows their stories know they're workaholics. Everybody, right? We know that. Okay. And the stuff they've gone through. Anyway, moving on. 3 recommended fields for the enterprising investment. To obtain better than average investment results over a long pull requires a policy of selection or operation possessing a twofold merit. Number 1, it must meet objective or rational tests of underlying soundness. And number 2, it must be different from the policy followed by most investors or speculators. Our experience and study leads us to recommend 3 investment approaches that meet these criteria. They differ rather widely from one another, and each may require a different type of knowledge and temperament on the part of those who essay it. The relatively unpopular large company. If we assume that it is the habit of the market to overvalue common stocks, which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue, relatively at least, companies that are out of favor because of unsatisfactory developments of a temporary nature. And it suggests an investment approach that should prove both conservative and promising. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity. That's like when Warren Buffett invested in American Express when they were in very unpopular times. While small companies may also be undervalued for similar reasons and in many cases may later increase their earnings and share price, they entail the risk of a definitive loss of profitability and also of protracted neglect by the market in spite of better earnings. The large companies thus have a double advantage over the others. First, they have the resources and capital and brain power to carry them through adversity and back to a satisfactory earnings base. Second, the market is likely to respond with reasonable speed to any improvements shown. A remarkable demonstration of the soundness of this thesis is found in studies of the price behavior of the unpopular issues in the Dow Jones Industrial Average. In these, it was assumed that an investment was made each year in either the 6 or the 10 issues in the Dow Jones Industrial Average which were selling at the lowest multipliers of their current or previous year's earnings. These could be called the cheapest stocks in the list, and their cheapness was evidently the reflection of relative unpopularity with investors or traders. It was assumed further that these purchases were sold at the end of holding periods ranging from 1 to 5 years. The results of these investments were then compared with the results shown in either the Dow Jones Industrial Average as a whole or the highest multiplier, the most popular group. Detailed material we have available covers the results of annual purchases assumed in each of the past 53 years. In the early period, 1917 to 1933, this approach proved unprofitable. But since 1933, the method has shown highly successful results. In 34 tests made by Drexel & Company, now Drexel Firestone, of 1 year holding, from 1937 through 1969, cheap stocks did definitively worse than the Dow Jones Industrial Average in only 3 instances. The results were about the same in 6 cases, and cheap stocks clearly outperformed the average in 25 years. The consistently better performance of the low multiplier stocks is shown in Table 7.2 by the average results for successive 5-year periods when compared with those of the Dow Jones Industrial Average and of the 10 high multipliers. Table 2, if you want to look at it on YouTube, you can take a screenshot or whatever, or if you are on Instagram, you can screenshot that. Go for it. Okay. So what it says is average annual percentage gain or loss on test issues, 1937, 1969. So as he said, in 1937 to 1942, it didn't do well. Okay, it did worse. Negative 2.2, 10 low multiplier issues. The 10 high multiplier issues did negative 10, and 30 Dow Jones Industrial Average stocks did negative 6.3. In 1943 and 1947, the 10 low multiplier issues did 17.3% gain. And the 10 high multiplier issues did 8.3% gain. 30 Dow Jones Industrial Average stocks did 14.9% gain. Okay? 1948 to 1952, the 10 low multiplier issues did 16.4% gain. The 10 high multiplier issues did a 4.6% gain. And the 30 Dow Jones Industrial Average stocks did 9.9% gain. So the 10 low multiplier issues are doing much better later on. 1953 to 1957, they have a 20.9% gain, which is huge, guys. 10 high multipliers only had a 10% gain, and the Dow Jones did 13.7%. 1958 to 1962 was a 10.2% gain. The 10 high multipliers had a negative 3.3% return, and 30 Dow Jones Industrial stocks did 3.6%. 1963 to 1969, which is 8 years, 8% gain for the 10 low multiplier issues, 4.6% gain for the 10 high multiplier issues, and 30 Dow Jones Industrial Average stocks did 4% gains. So as you can tell, the gain from the 10 low multiplier issues is far higher than if you just owned a bunch of Dow Jones Industrial Average stocks, and also much more higher in general than if you owned the 10 high multiplier issues in the Dow Jones Industrial Average. The Drexel computation shows further that an original investment of $10,000 made in the low multiplier issues in 1936 and switched each year in accordance with the principle would have grown to $66,900 by 1962. The same operation in high multiplier stocks would have ended with a value of only $25,300, while an operation of all 30 stocks would have increased the original fund to $44,000. The concept of buying unpopular large companies and its execution on a group basis, as described above, are both quite simple. Actually, it sounds like I read the autobiography of Warren Buffett, and I know he did that with American Express, and he does it with various companies. So I guess he's kind of doing basically this strategy here. But in considering individual companies, a special factor of opposite import must sometimes be taken into account. Companies that are inherently speculative because of widely varying earnings tend to sell both at relatively high and at relatively low multipliers in their good years. Conversely, at low prices and high multipliers in their bad years. These relationships are illustrated in Table 7.3, covering fluctuations of Chrysler Corp. Common. In these cases, the market has sufficient skepticism as to the continuation of the unusually high profits to value them conservatively, and conversely, when earnings are low or non-existent. Note that by the arithmetic, if a company earns next to nothing, its shares must sell at a high multiplier of these minuscule profits. Excuse me. Whew. Okay. 7.3. Table 7.3. There you go. And then in Instagram, Table 7.3. Okay. Chrysler common prices and earnings from 1952 to 1970. So he's talking about Chrysler. In 1952, their earnings per share was $9. Their price high or low price, okay? So their high price was $98, and their price to earnings ratio was 10.8. So dividing the price by the earnings was 10.8. 1954, the earnings per share were 2.13. The low price was 56, and their price to earnings ratio was 26.2. In 1955, the earnings per share was $11.49. The high price was 101.5. Price per earnings ratio was 8.8. 1956, $2.29 were the earnings per share. The low price of 52 in 1957 gave them a price to earnings ratio of 22.9. Wow. In 1957, their earnings swing really wildly. I guess that's what he's talking about. Companies that are inherently expected because of widely varying earnings. Yeah, this company has very widely varying earnings. Okay. 1956, they had, 1957, they had $13.75 earnings per share. They had a high of 82. Price per earnings ratio was 6.7. 1958, 3.88 earnings per share. Their low price was 44. I don't know what 44 with an A means, but he doesn't have price per earnings. In 1968, it was 24.92 earnings per share. Jeez. The high was $294 a share, and it had 11.8% price per earnings. Okay. Alrighty then. In most cases, the market has sufficient skepticism as to the continuation of the unusual high profits to value them conservatively, and conversely, when earnings are low or non-existent, note by the arithmetic of a company earns next to nothing, its shares must sell at a high multiplier of its minuscule profits. As it happens, Chrysler has been quite exceptional in the Dow Jones Industrial Average list of leading companies, and hence it did not greatly affect the low multiplier calculations. It would be quite easy to avoid inclusion of such anomalous issues in a low multiplier list by requiring also that the price be low in relation to past average earnings or by some similar test. While writing this revision, we tested the results of the Dow Jones Industrial Low Multiplier method applied to a group assumed to be bought at the end of 1968 and revalued on June 30th, 1971. This time, the figures proved quite disappointing, showing a sharp loss for the low multiplier 6 or 10 and a good profit for the high multiplier selections. This one bad instance should not vitiate conclusions based on 30-odd experiments, but its recent happening gives it a special adverse weight. Perhaps the aggressive investor should start with the low multiplier idea, but add other quantitative and qualitative requirements thereto in making up his portfolio. Purchase or bargain issues. So this is the second strategy. We define a bargain issue as one which, on the basis of facts established by analysis, appears to be worth considerably more than it is selling for. The genus includes bonds and preferred stocks selling well under par, as well as common stocks. To be as concrete as possible, let us suggest that an issue is not a true bargain unless the indicated value is at least 50% more than the price. What kind of facts would warrant the conclusion that so great a discrepancy exists? How do bargains come into existence, and how does the investor profit from them? There are two tests by which a bargain common stock is detected. The first is by the method of appraisal. This relies largely on estimating future earnings and then multiplying these by a factor appropriate to the issue. If the resultant value is sufficiently above the market price, and if the investor has confidence in the technique employed, he can tag the stock as a bargain. The second test is the value of the business to a private owner. This value also is often determined chiefly by expected future returns, in which case the result may be identical with the first. But in the second test, more attention is likely to be paid to the realizable value of the assets, with particular emphasis on the net current assets or working capital. At low points in the general market, a large proportion of common stocks are bargain issues, as measured by these standards. Typical example was General Motors, when it sold at less than 30 in 1941, equivalent to only 5 for the 1971 shares. It had been earning in excess of $4 and paying $3.50 or more in dividends. It is true that the current earnings and the immediate prospects may both be poor, but a level-headed appraisal of average future conditions would indicate values far above ruling prices. Thus, the wisdom of having courage in depressed markets is vindicated not only by the voice of experience, but also by application of plausible techniques of value analysis. That would be now, right? We're in a depressed market. But who knows, right? People are wondering when Delta is going to go out of business. Yeah. The same vagaries of the market place that recurrently establish a bargain condition in the general list account for the existence of many individual bargains at almost all market levels. The market is fond of making mountains out of molehills and exaggerating ordinary vicissitudes into major setbacks. Even a mere lack of interest or enthusiasm may impel a price decline to absurdly low levels. Thus, we have what appear to be two major sources of undervaluation. One, currently disappointing results, and two, protracted neglect or unpopularity. However, neither of these causes, if considered by itself alone, can be relied on as a guide to successful common stock investment. How can we be sure that the currently disappointing results are indeed going to be only temporary? How do we know that Delta is going to stay in business? They might go out of business right now. That's my own search. He didn't write that about Delta. I just said that, okay? Anyway, when I read, especially books with older English, I like to put in my own thoughts to help me absorb the material. So every now and then I might talk about today, pandemic, Delta, whatever, just to make it hit my brain, right? What he's talking about is what's going on today, right? You have a depressed market. How do you know which company is really, you think, oh, they're so strong, but they might not survive this. Yeah. How do you know? Okay. True. We can supply excellent examples of that happening. The steel stocks used to be famous for their cyclical quality, and the shrewd buyer could acquire them at low prices when earnings were low and sell them in boom years at a fine profit. A spectacular example is supplied by Chrysler Corporation, as shown by the data in Table 7.3. If this were the standard behavior of stocks with fluctuating earnings, then making profits in the stock market would be an easy matter. Unfortunately, we could cite many examples of declines in earnings and price that were not followed automatically by a handsome recovery of both. Yeah, I've seen it. A company will announce great earnings and their price will drop. A company will announce that they lost and their price goes up. It doesn't happen that way all the time, but I've seen it happen so often that it's like, just because they say they earned something has no effect. It's like it's not that it has no effect. It's like you cannot predict what that will do to the share price with any sort of predictable anything. Okay, so let's move on. All right. One such was Anaconda Wire and Company, which had large earnings up to 1956, with a high price of 85 in that year. The earnings then declined irregularly for 6 years. The price fell to 23.5 in 1962, and the following year it was taken over by its parent enterprise, Anaconda Corporation, at the equivalent of only 33. The many experiences of this type suggest that the investor would need more than a mere falling off in both earnings and price to give him a sound basis for purchase. He would require an indication of at least reasonable stability of earnings over the past decade or more, i.e., no year of earnings deficit, plus sufficient size and financial strength to meet possible setbacks in the future. The ideal combination here is thus that of a large and prominent company selling both well below its past average price and its past average price earnings multiplier. This would no doubt have ruled out most of the profitable opportunities in companies such as Chrysler, since their low price years are generally accompanied by high price earnings ratios. But let us assure the reader now, and no doubt we shall do it again, that there is a world of difference between hindsight profits and real money profits. Hindsight is 2020. We doubt seriously whether the Chrysler type of roller coaster is a suitable medium for operations for our enterprising investor. We have mentioned protracted neglect or unpopularity as the second cause of price declines to unduly low levels. Current case of this kind would appear to be National Presto Industries. In the bull market of 1968, it sold at a high of $45, which was only 8 times the $5.61 earnings for that year. The per share profits increased in both 1969 and 1970, but the price declined to only 21 in 1970. This was less than 4 times the record earnings in that year and less than its current net asset value. In March 1972, it was selling at 34, still only 5.5 times the last reported earnings, and at about its enlarged net current asset value. Okay, another example of this type is provided currently by Standard Oil of California, a concern of major importance. In early 1972, it was selling at about the same price as 13 years before, say 56. Its earnings had been remarkably steady with relatively small growth, but with only one small decline over the entire period. Its book value was about equal to the market price. With this conservatively favorable 1958 to 1971 record, the company has never shown an average annual price as high as 15 times its current earnings. In early 1972, the price-earnings ratio was only about 10. A third cause for an unduly low price for a common stock may be the market's failure to recognize its true earnings picture. Our classic example here is Northern Pacific RY. I'm not sure what RY means, but which in 1946 to 1947 declined from 36 to 13 and a half. The true earnings of the road, it's a road, okay, in 1947 were close to $10 per share. The price of the stock was held down in great part by its $1 dividend. It was neglected also because much of its earning power was concealed by accounting methods peculiar to railroads. The type of bargain issue that can be most readily identified as a common stock that sells for less than the company's net working capital alone after deducting all prior obligations. This would mean that the buyer would pay nothing at all for the fixed assets, buildings, machinery, etc., or any goodwill items that might exist. Very few companies turn out to have an ultimate value less than the working capital alone, although scattered instances may be found. The surprising thing, rather, is that there have been so many enterprises obtainable which have been valued in the market on this bargain basis. Compilation made in 1957, when the market's level was by no means low, disclosed about 150 of such common stocks. In Table 7.4, we summarize the result of buying on December 31st, 1957, one share of each of the 85 companies in that list for which data appeared in Standard & Poor's monthly stock guide and holding them for 2 years. So he has New York Southeast, I guess these are all. Location of the market is the New York Southeast, America Southeast, Midwest Southeast, over the counter. So there's the table if you want to screenshot it. There's the table. Okay. All right. So the number of companies in the New York Southeast was 35. The average net current assets per share was $748. And the aggregate price in 1957 was $419. And the aggregate price December 1959 was $838. Okay, so they were selling below the aggregate net of their current assets per share. Okay, so American Southeast, there were 25 companies. The aggregate net current assets per share was $495. Their price was $289, which is much lower. And in 1957, it was $289. In 1959, it went up to $492. Midwest Southeast, there were 5 companies. $163 was their net assets per share. They were selling in 1957 for $87 a share. It went up to $141 a share in 1959. And over the counter, whatever that means, I'm sure it's an older term. There were 20 companies that were over the counter that had aggregate net current assets of $425 a share. Their price was only $208 per share in 1957. And they sold for $433 in 1959. So if you had invested in these bargain shares in 1957 at $1,083, you would have made almost $900 in 2 years out of 1,000. So that's a huge return, right? $1,083 becomes $1,904 in 2 years. All right. In Table 7.4, we summarize the result of buying on December 31st, 1957, one share of each of the 85 companies in that list for which data appeared in Standard & Poor's monthly stock guide and holding them for 2 years. By something of coincidence, each of the groups advanced in the 2 years to somewhere in the neighborhood of the aggregate net current asset value. The gain for the entire portfolio in that period was 75% against 50% for Standard & Poor's 425 industrials. Which is more remarkable is that none of the issues showed significant losses. 7 held about even, and 78 showed appreciable gains. Our experience with this type of investment selection on a diversified basis was uniformly good for many years prior to 1957. Can probably be affirmed without hesitation that it constitutes a safe and profitable method of determining and taking advantage of undervalued situations. However, during the general market advance after 1957, the number of such opportunities became extremely limited, and many of those available were showing small operating profits or even losses. The market decline of 1969 to 1970 produced a new crop of these sub-working capital stocks. We discussed this group in Chapter 15 on stock selection for the enterprising entrepreneur. See, that would be good for us right now because the market is down. So maybe there are bargain shares where the price per share is less than if you sold everything in the company. Bargain issue pattern in secondary companies. We have defined a secondary company as one that is not a leader in a fairly important industry. Thus, it is usually one of the smaller concerns in its field, but it may equally well be the chief unit in an unimportant line. By way of exception, any company that has established itself as a growth stock is not ordinarily considered secondary. In the great bull market of the 1920s, relatively little distinction was drawn between industry leaders and other listed issues, provided the latter were of respectable size. The public felt that a middle-sized company was strong enough to weather storms and that it had a better chance for really spectacular expansion than one that was already in major dimensions. The Depression years of 1931 to 1932, however, had a particularly devastating impact on the companies below the first rank, either in size or inherent stability. As a result of that experience, investors have since developed a pronounced preference for industry leaders and a corresponding lack of interest most of the time in the ordinary company of secondary importance. This has meant that the latter group have usually sold at much lower prices in relation to earnings and assets than have the former. It has meant further that in many instances the price has fallen so low as to establish the issue in the bargain class. When investors rejected the stocks of secondary companies, even though these sold at relatively low prices, they were expressing a belief or fear that such companies faced a dismal future. In fact, at least subconsciously, they calculated that any price was too high for them because they were heading for extinction, just as in 1929, the companion theory for the blue chips was that no price was too high for them because their future possibilities were limitless. Both of these views were exaggerations and were productive of serious investment errors. Actually, the typical middle-sized listed company is a large one when compared with the average privately owned business. There is no sound reason why such companies should not continue indefinitely in operation, undergoing the vicissitudes characteristics of our economy, but earning on the whole a fair return on their invested capital. So he's saying medium-sized companies that aren't the hugest companies, but are pretty big companies, there's no reason to believe they will go out of business, for sure, in comparison to large companies. This is very relevant for today, don't you think? I mean, we're in this depression. There are big companies. You don't know if they're going to survive, like I said, Delta, right? Or any of the airlines or any of the hotels, you don't know. But then medium to large restaurants, do you know whether they'll survive? I mean, once we can eat out again, I'm sure we will, right? But when, right? It's not going to last forever. Everybody knows that. Yeah. It's really interesting to read this. The brief review indicates that the stock market's attitude towards secondary companies tends to be unrealistic and consequently to create in normal times innumerable instances of major undervaluation. As it happens, the World War II period and the post-war boom were more beneficial to the smaller concerns than to the larger ones, because then the normal competition for sales was suspended and the former could expand sales and profit margins more spectacularly. Thus, by 1946, the market's pattern had completely reversed itself from that before the war. Whereas the leading stocks in the Dow Jones Industrial Average had advanced only 40% from the end of 1938 to the 1946 high, Standard & Poor's index of low-priced stocks had shot up no less than 280% in the same period. Speculators and many self-styled investors with the proverbial short memories of people in the stock market, were eager to buy both old and new shares of unimportant companies at inflated levels. Thus, the pendulum had swung clear to the opposite extreme. The very class of secondary issues that had formerly supplied by far the largest proportion of bargain opportunities was now presenting the greatest number of examples of overenthusiasm and overvaluation. In the different way, this phenomenon was repeated in 1961 and 1968, the emphasis now being placed on new offerings of the shares of small companies of less than secondary character, and on nearly all companies in certain favored fields such as electronics, computers, franchise concerns, and others. As was to be expected, the ensuing market declines fell most heavily on these overvaluations. In some cases, the pendulum swing may have gone as far as definite undervaluation. If most secondary issues tend normally to be undervalued, what reason has the investor to believe that he can profit from such a situation? 4. If it persists indefinitely, will he not always be in the same market position as when he bought the issue? The answer here, turning the page. The answer here is somewhat complicated. Substantial profits from the purchase of secondary companies at bargain prices arise in a variety of ways. First, the dividend return is relatively high. Okay, so dividends bring about profits for secondary issues. Here goes me. Okay. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In 5 to 7 year period, these advantages can bulk quite large in a well-selected list. Thus, a bull market is ordinarily most generous to low-priced issues. Thus, it tends to raise the typical bargain issue to at least a reasonable level. Fourth, even during relatively featureless market periods, a continuous process of price adjustment goes on, under which secondary issues that were undervalued may rise at least to the normal level for their type of security. Fifth, the specific factors that in many cases made for a disappointing record of earnings may be corrected by the advent of new conditions, or the adoption of new policies, or by a change in management. An important new factor in recent years has been the acquisition of smaller companies by larger ones, usually as part of a diversification program. In these cases, the consideration paid has almost always been relatively generous and much in excess of the bargain levels existing not long before. When interest rates were much lower in 1970, the field of bargain issues extended to bonds and preferred shares that sold at large discounts from the amount of their claim. Currently, we have a different situation in which even well-secured issues sell at large discounts if carrying coupon rates of, say, 4.5% or less. AT&T is 2 5/8 due 1986, sold as low as 51 in 1970. Deere & Company, 4.5s, due 1983, sold as low as 62. These may well turn out to have been bargain opportunities before very long if ruling interest rates should decline substantially. For a bargain bond issue in the more traditional sense, perhaps, we shall have to turn once more to the first mortgage bonds of railroads, now in financial difficulties, which sell in the 20s or 30s. Such situations are not for the inexpert investor. Lacking a real sense of values in this area, he may burn his fingers. But there is an underlying tendency for market decline in this field to be overdone. Consequently, the group as a whole offers an especially rewarding invitation to careful and courageous analysis. In the decade ending in 1948, the billion-dollar group of defaulted railroad bonds presented numerous and speculative opportunities in this area. Such opportunities have been quite scarce since then, and they seem likely to return in the 1970s. Okay. Special situations or workouts, third strategy. Not so long ago, this was a field that could almost guarantee an attractive rate of return to those who knew their way around in it. And this was true under almost any sort of general market situation. It was not actually forbidden territory to members of the general public. Some who had a flair for this sort of thing could learn the ropes and become pretty capable practitioners without the necessity of long academic study or apprenticeship. Others have been keen enough to recognize the underlying soundness of this approach and to attach themselves to bright young men who handled funds devoted chiefly to these special situations. Instagram is about to end, so anyone on Instagram, check out the blog, yesfinanciallyfree.com, and get the whole replay of this recording. It is there. I'm recording it at the same time on YouTube, so go there, yesfinanciallyfree.com. I'm going to share that on Instagram, and we will continue here. This is a long reading today. The typical special situation has grown out of the increasing level of acquisitions of smaller firms by large ones, as the gospel of diversification of products has been adopted by more and more managements. It often appears good business for such an enterprise to acquire an existing company in the field it wishes to enter rather than to start a new venture from scratch. That makes sense. In order to make such acquisition possible and to obtain acceptance of the deal by the required large majority of stockholders of the smaller company, it almost always necessary to have a price considerably above the current level. Such corporate moves have been producing interesting profit-making opportunities for those who have made a study of this field and have good judgment fortified by ample experience. A great deal of money was made by shrewd investors not so many years ago through the purchase of bonds of railroads in bankruptcy, bonds which they knew would be worth much more than their cost when the railroads were fully reorganized. After promulgation of the plans of reorganization, when the issued market for the new securities appeared, these could also be almost always be sold for considerably more than the cost of the old issues, which were to be exchanged therefore. There were risks of non-consummation of the plans or of unexpected delays, but on the whole, such arbitrage operations proved highly profitable. There were similar opportunities growing out of the breakup of public utility holding companies pursuant to 1935 legislation. Nearly all these enterprises proved to be worth considerably more than when changed from holding companies to a group of separate operating companies. The underlying factor here is a tendency, somebody checkmark this. The underlying factor here is the tendency of the security markets to undervalue issues that are involved in any sort of complicated legal proceedings. An old Wall Street motto has been, never buy into a lawsuit. This may be sound advice to the speculator seeking quick action on his holdings, but the adoption of this attitude by the general public is bound to create bargain opportunities in the securities affected by it. Since the prejudice against them holds their prices down to unduly low levels, the exploitation of special situations is a technical branch of investment which requires a somewhat unusual mentality and equipment. Probably only a small percentage of our enterprising investors are likely to engage in it, and this book is not the appropriate medium for expounding its complications. Broader implications of our rules of investment. So he had three strategies. One was to buy large companies that are just being undervalued, but they're large, and to do that every year. His second strategy is to buy bargain investments, trading at way lower than their value. Like if you sold the whole company and got money, it's trading way lower than that. And that was the other one. And the third one is to trade in companies that are under bankruptcy, being reorganized, that you know will turn out okay, or companies that you know will be bought out, or because they tend to be bought out at higher prices than they're worth, and once people are reorganized, money comes in again, like railroads and things. But he says he's not going to explain how to do the third method in here because it needs special skills. Okay. Broader implications of our rules for investment. Investment policy, as it has been developed here, depends in the first place on the choice by the investor of either the defensive, passive, or aggressive enterprising role. The aggressive investor must have a considerable knowledge of security values, enough, in fact, to warrant viewing his security operations as equivalent to a business enterprise. There is no room in this philosophy for a middle ground or a series of gradations between the passive and aggressive status. Many, perhaps most investors seek to place themselves in such an intermediate category. In our opinion, that is a compromise that is more likely to produce disappointment than achievement. As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds. It follows from this reasoning that the majority of security owners should elect the defensive classification. They do not have the time or the determination or the mental equipment to embark upon investing as a quasi-business. They should therefore be satisfied with the excellent return now obtainable from a defensive portfolio, and with even less. They should stoutly resist their recurrent temptation to increase this return by deviating into other paths. The enterprising investor may properly embark upon any security operation for which his training and judgment are adequate and which appears sufficiently promising when measured by established business standards. In our recommendations and caveats for this group of investors, we have attempted to apply such business standards. In those for the defensive investor, we have been guided largely by the three requirements of underlying safety, simplicity of choice, and promise of satisfactory results in terms of psychology as well as arithmetic. The use of these criteria has led us to exclude from the field of recommended investment a number of security classes that are normally regarded as suitable for various kinds of investors. These prohibitions were listed in our first chapter on page 11. Let us consider a little more fully than before what is implied in these exclusions. We have advised against the purchase at full prices of three important categories of securities. Foreign bonds, do not ever purchase. Do not ever purchase ordinary preferred stocks, and do not ever purchase secondary common stocks, including, of course, our original offerings of such issues. By full prices, we mean prices close to par for bonds or preferred stocks, and prices, don't buy these three categories at full price, okay? That is foreign bonds, ordinary preferred stocks, and secondary common stocks. By full price, we mean prices close to par for bonds or preferred stocks, and prices that represent above the fair business value of the enterprise in the case of common stocks. The greater number of defensive investors are to avoid these categories regardless of price. The enterprising investor is to buy them only when obtainable at bargain prices, which we define as prices no more than 2/3 of the appraised value of the securities. Yes, this is a long chapter. What would happen if this is Jordan. He's my son. Say hi. Let's say hi. Hi. Okay. What would happen if all investors were guided by our advice in these matters? That question was considered in regard to foreign bonds on page 67. We have nothing to add at this point. Investment-grade preferred stocks would be bought solely by corporations such as insurance companies, which would benefit from the special income tax status of stock issues owned by them. The most troublesome consequence of our policy of exclusion is in the field of secondary common stocks. If the majority of investors, being in the defensive class, are not to buy them at all, the field of possible buyers becomes seriously restricted. Furthermore, if aggressive investors are to buy them only at bargain levels, then these issues would be doomed to sell for less than their fair market value, except to the extent that they are purchased unintelligently. This may sound severe and even vaguely unethical, yet in truth, we are merely recognizing what has actually happened in this area for the greater part of the past 40 years. Secondary issues, for the most part, do fluctuate above a certain level, which is well below their fair market value. They reach and even surpass that value at times, but this occurs in the upper reaches of bull markets, when the lessons of practical experience would argue against the soundness of paying the prevailing prices for common stocks. Thus, we are suggesting only that the aggressive investor recognize the facts of life as it is lived by secondary issues, and that they accept the central market levels that are normal for that class as their guide in fixing their own levels for purchase. There is a paradox here, nevertheless. The average well-selected secondary company may be fully as promising as the average industrial leader. What the smaller concern lacks in inherent stability, it may readily make up in superior possibilities of growth. Consequently, it may appear logical to many readers to term unintelligent the purchase of such secondary issues at their full enterprise value. We think that the strongest logic is that of experience. Financial history says clearly that the investor may expect satisfactory results on average from secondary common stocks only if he buys them for less than their value to a private owner. That is on a bargain basis. The last sentence indicates that this principle relates to the ordinary outside investor. Anyone who can control a secondary company or who is part of a cohesive group with such control is fully justified in buying the shares on the same basis as if he were investing in a close corporation or other private business. The distinction between the position and consequent investment policy of insiders and of outsiders becomes more important as the enterprise itself becomes less important. It is a basic characteristic of a primary or leading company that a single detached share is ordinarily worth as much as a share in a controlling block. In secondary companies, the average market value of a detached share is substantially less than its worth to a controlling owner. Because of this fact, the matter of stockholder management relations and of those between inside and outside stockholders tends to be much more important and controversial in the case of secondary than of primary companies. At the end of chapter 5, we commented on the difficulty of making any hard and fast distinction between primary and secondary companies. The many common stocks in the boundary area may properly exhibit an intermediate price behavior. It would not be illogical for an investor to buy such an issue at a small discount from its indicated or appraised value, on the theory that it is only a small distance away from a primary classification and that it may acquire such a rating unqualifiedly in the not-too-distant future. Thus, the distinction between primary and secondary issues need not be too precise, for if it were, then a small difference in quality may produce a large differential in justified purchase price. In saying this, we are admitting a middle ground in the classification of common stocks, although we counseled against such a middle ground in the classification of investors. A reason for this apparent inconsistency is as follows. No great harm comes from such uncertainty of viewpoint regarding a single security, because such cases are exceptional and not a great deal is at stake in the matter. But the investor's choice as between the defensive or the aggressive status is of major consequence to him, and he should not allow himself to be confused or compromised in this basic decision. And that is the end of chapter 7. We have been reading for a long time. That was a long chapter. Thank you for being here. And if you want to see the full summary, yes, financiallyfree.com. Get on the email list, put in your first name, email address on the right side. My name is May Duldalau. This is Jordan Duldalau. Want to say hi? He already said hi, but he's been waiting for me. So we're going to end this stream. Have a great day, guys. Aloha and bye.